I would like to take this opportunity to get your views on markets in general. We have had a stellar run over the last couple of months, and we almost touched 20,000 levels on Nifty, and then there has been some bit of consolidation over the last couple of weeks. And FIs have been continuous net buyers for 5 months till July, and in August till now, there seems to be some change in trend. So, what's your view on markets in general?
Right, I think very interesting phase and turn of events, I would say. It's that, this unique dilemma that one faces every now and again. If you look at the extremely long term, it's difficult to find an economy as good as India, as large as India, in such a good state of affairs. Right, so if you look around at somewhere around 3.5 trillion or thereabouts, you don't have a lot of economies available for a lot of investors at this juncture. Now, the two large parts that we are looking into are one, today the working age population in India is somewhere around 83 crore people. Over the next 2 decades, we will be crossing 110 crore people. Right now, a number in addition this large essentially implies that sort of the amount of work that gets created in the process is phenomenal. That's number one. Number two, one way to look at it here again could be, oh, where are the jobs? What will people do? But then today, just imagine these people are, for the lack of a better word, sort of freeloading onto the economy. Right? They're drawing from the national reservoir, and tomorrow, if they even accept menial jobs, they'll start adding to it. When 17 crore people, 20 crore people add to this, wonders happen with the country's destinies. Secondly, for a country of India's size, we are at 3.5 trillion or thereabouts, but your per capita GDP is 127th in the world, and at such a low level, you're still 62% deriving, income from services. So the manufacturing boom which we left out in the process, what's the standard template, right? The standard template is become the manufacturing hub of the world, and then have a control over your current account, and then that allows you to get a control over your BOP. Now that cycle we missed, and in missing that cycle, we are now trying to sort of salami slice our way back into it, right? So what's the government trying to tell us? All right, you can, start manufacturing the 50,000 rupee phone, captures at least 1,000 rupee in value first. Then they go ahead and say, okay, can you make this glass here, capture a little more? Can you go and make a semiconductor plant, try and get something part there? So I think you're salami slicing your way into manufacturing. And all this, if you look at it from a long-term standpoint, makes a lot of sense. You can jargonize it by saying, your labor force production, participation, pardon me, and your productivity gains both will likely improve, and that is the fundamental fabric of any economy. Now, from there, you go on to flows, and 3.5 trillion, a country with a large consumption base, absolutely nicely working sort of democracy, pardon me. Thirdly, very strong judicial system. What is the next in round, right? Saudi at a 2.5 trillion is largely oil. Brazil at 2 trillion is largely commodities. So it's a difficult country which is growing as fast as it is for FIs to ignore, and equally difficult for even domestic investors to park their money in. So long term, clearly we are in the same camp as everybody else. India presents a huge opportunity, and it's something where equity exposure should be commensurately high for everybody to take advantage of things. In the shorter term, however, we are slightly split, right? And this is a very interesting turn of events, because as we see it, there are two broad, scenarios that could play out. And let's call one central bankers are, God's scenario. Start with the premise there that economics is an exact science. Economies have no lag whatsoever. Central bankers are exactly aware how much to raise interest rate so that the economies don't sort of go into recession but only correct a little bit. And there enough time passes, inflation, as you know, is a funny concept, right? So a 100 rupee item going to 120 is a 20% inflation in 1 year. 120 staying 120 the next year is 0% inflation. So with the passage of time, inflation could come off without prices actually correcting.
Yeah.
And that is the Goldilocks scenario with everybody seems to be pricing into the markets today. that eventually with the passage of time you should come out of this smelling like roses. Of the 1280 companies with more than 500 crores in market cap today, 25% of these, right, so a little over 400, have actually gone up 50% or more. 60 companies have doubled in a matter of just the past 4 months. So things are great over the longer term, but I think we may be extending to a small extent on the other side of the pendulum. The other scenario clearly is that beyond a point, nobody knows anything, right? So nobody knows anything beyond a point scenario, where you know that economics is not an exact science. Like physics work on three laws, economics is not that science.
Yeah.
Behavior plays a very large part. And when the interest rate is raised from 0% to something like 5.5%, there are skeletons waiting in the closet, waiting to tumble out, right? For far too long, the interest rate has been kept at a very low level, and that creates excesses which blow out eventually, in times when your QT is very high, your interest rates are very high. And for a lack of any other logic, try discounting a US risk-free 5.5 forever. Right, so you start with a US risk-free at 5.5. You add a country risk premium for India, which by the way today is just 100 basis points, which is a 23-year low, the Fed fund target rate versus the repo.
Yeah.
Right, and that used to be like 800 basis points in 2013, 400 basis points in COVID. So we are at a very small number. And try building country risk premium, companies risk premium, and try putting that in your DCF models. The valuations for most companies you will get is much lower than when we are today.
Sure.
So I think we are split between those two junctures. In our opinion, there will be a time later in the year to dial the risk up. 10 years absolutely is a great time to be invested in equities, but I think people may be rushing into it, trying to discount a lot way too soon.
Sure. And how are you approaching markets at Buoyant?
Right, so for us, see, we have a few things going in the way that we do not follow a model portfolio.
Sure.
Right, I think that is very critical, especially for PMSs/managed accounts. Uh, Everybody, I think, in their right mind would agree that you should not be following a model portfolio. If you have say 25 stocks in your portfolio and money is hitting your account every single day, not all 25 are buys every single day, right? You may be in the process of selling out a few. There is no point in you buying the shares today only to sell a week, a month down the line. The reason why people do it is because sort of, it's a logistical nightmare. You can't run 5,000 accounts on an Excel sheet.
Sure.
With varying weights. So the practical solution is, just you copy paste the portfolios, right? And that's a sort of decent way to do it. But then there is a better way. When we started working with an IT company. We now have a full solution in place which allows us to run and create each portfolios as we go along.
Sure.
So when we were in March, we were essentially saying that we are investing sort of entire portfolio in a week or so, because we could buy businesses which made a lot of sense from a longer term standpoint. Today, when we are receiving, a lot of our shares have also doubled in the process of the last 4 months or so. And what we are now saying is that we are taking somewhere around 3 to 4 months from how things appear today.
Sure.
To fully invest.
Sure.
And also, so one part is, timing the entry into creating a portfolio. The other clear part, and internally we manage it with core and satellite, and I think as this discussion progresses, we'll talk further.
Yeah.
But I think if you break it down from a simple large, mid cap, small cap perspective, then, I'll run you through a little bit of the history here. In Jan 2022, we were roughly around 70% in large caps and cash. We had turned defensive.
Sure.
The markets were still looking for the next multi-bagger.
Sure.
We couldn't find businesses which made a lot of sense. Obviously, we weren't aware that Russia-Ukraine conflict would transpire. At that point in time, we said, let's just hold on, makes sense. A lot of dividend yielding names made a lot of sense. With the Russia-Ukraine conflict and the ensuing sort of mayhem, the small cap exposure, even with us, stood at a minuscule level. And we started building that until March 2023, when small caps became 50% of our entire portfolio. Now, with the rally that has transpired, We are taking time to sort of clip off a lot of those positions. As we speak, we are still somewhere around 43%. Now that 50% in fact has outperformed by huge margin. Right, so you are cutting 20% odd positions in small caps. You still have an extremely large outperformance to contend with, and that we are taking money off as we speak. If we are investing a new portfolio, much larger size is getting into large caps rather than the 40% small cap that we have today.